Also want to just thank everybody else for taking the time out of your day to listen to us today. And hopefully we'll be able to share a few tips for you. Really, to start out, just wanted to talk a little bit about budgeting, obviously. Budgeting is not just something for larger businesses and organizations. I think it gets that perspective comes into it. But the structure and planning that this process provides is extremely valuable to all types and sizes of businesses and organizations. So something for those that really don't get into the budgeting side of it, I think the planning piece that is extremely important. So start out really with, what is a budget? A budget is really the financial plan for the future year or for a specified period of time. So this is how true financial planning of the company or organization is going to be based on. Apparently I am cutting in and out, so I'll try to work on that. So basically, the plan can be very at a summary standpoint or also very detailed. It can consist of revenue and expenses and just be focused on the P&L, or it's something that can incorporate balance sheet and cash flow items as well to be a little more extensive. So why do we want a budget? Budget is going to provide a clear path for everyone to follow and give us something to benchmark against. So how did we plan for the year to go, and how is it going when we compare to that plan? It provides for planning for growth. As I said, if we go to a certain level of detail, it can also provide us planning for cash flow needs, which can go into what we need to have available to us for debt and other things to provide cash. And also, from my personal perspective, I enjoy the fact that it allows for tax planning throughout the year, knowing kind of what our plan for the year will be and what kind of impact that could have from a tax standpoint, and how we can provide projections and plan to how to best utilize the tax laws available to us. So how do we get started in the budget process? We first got to look at setting goals for our budget. So what's our primary focus going to be? Is our focus going to be, we want to grow revenue? Maybe we want to reduce expenses. Maybe we're in a good spot and we just want to maintain that. We just need to kind of, and maybe it's a combination of those things. It may be that we want to grow revenue and reduce expenses because we want to get to a certain net income number. And so what we can do in that case is pick what that net income might be based on maybe a certain return on investment or something like that we want to get to, and set that number and work backwards from there in terms of what revenue and expenses need to be in order to make that happen. Once we have that process or that goal kind of started, it's time to put pen to paper, basically. We've got to probably even before we get to what we've got here lined out on our slide is we usually will see where clients will pull information from their accounting system or their financial statements from the prior year, maybe export that into Excel or just have that information available. And you kind of start from last year initially, or start from projections if you're a new organization, and start filling in the blanks, if you will, on what this year is going to look like. But as you do that, there's certain things you have to consider instead of just throwing down a number similar to last year. So you've got to think about what changes are going to affect your future operations. So what are market conditions? Are there changes in your industry? Are there additional compliance pieces that are going to either decrease revenue or increase expenses? And maybe you're going to add an additional location this year. And again, that may have additional expenses and a lag to revenue as you're starting that up, or maybe you think there's going to be a boost in something else. And obviously, the political and tax changes that might come into play can affect different businesses in different ways, depending on what your industry is. And so those are all things that need to be considered, and not just, okay, well, budget was this last year and all expenses go up by 10% and income's going up by 20%, and therefore our net income is going to be better. We need to think about what are the things that are really happening in the background to make those changes.
And to add to your comments, John, so as he was alluding to, it's easy to throw your information into Excel from prior years. So there are specific like budgeting softwares when you start to get into the process. I will say, of course, like Excel is the easiest, but as always, it's the easiest to, inadvertently make a mistake in as well. So, when you're kind of looking at some programs, and of course it depends on what you're currently working in, it depends on, what your size is or your needs specific to your industry. But Centage, NetSuite, Scoro are a few of them. Profix is another one for larger companies that can kind of sit on top of your software and helps consolidate that with minimal errors that you might incur in Excel.
Agreed. So once you've kind of started that process of thinking through those things and getting that down on paper, you've also got to then take a step back. So the budgeting process is kind of a lot of ins and outs. You've got to get into the details, step back from the details, get back into the details, and then step back, and you're constantly working on iterations to analyze kind of where you are and where you've been with it. So we want to compare those results to prior period and also to our industry peers if that's available to us. So starts out with what lessons have we learned? Obviously, we're comparing to prior years, but we also need to look at what went well and what maybe didn't go so well. So how do we do that again, or how do we avoid that as we go forward? How do we incorporate that into our numbers? Maybe there's a different cost that's going to be in play that will help us generate the same revenue at a different cost, or maybe we have to invest in this for the future, etc. We may have to re-strategize if we had things that didn't go well in the prior year. Or there may be just changes that come out of the blue. I don't know if anybody heard of this COVID thing, but that's obviously put a lot of changes for a lot of businesses, some good, some bad, probably mostly bad. But PPP has been a huge process. And so how does that come into play? Those are things that nobody knew about. I think you might have been slightly aware of coronavirus in December and January when you were working on the budgets for 2020, but obviously I don't think anybody expected where things came. And so those are definitely things that you would have to re-strategize as you go through. And as you're looking at 2021 budgets, we may not know exactly what those things mean either, but you've got to take a stab at that. Just certain things like what's our inventory levels, and do we need cash for inventory, or do we have enough inventory on hand to go ahead and produce the sales that we need if we were to sell it all? Do we have additional cash on hand that can be used to create greater vendor discounts and therefore lower our cost of sales? We need to look at all of those types of things. We also need to look at, non-recurring items. Excuse me. Make sure not to budget for those. So we might have had, obviously, well, it may be reoccurring, but PPP funds were things that came in. A lot of people are going to see that on their cash flow and financials from 2020 that I think at this point we'd say that probably isn't going to reoccur. And so you don't necessarily want to build that into a budget. Obviously, you want to stick with what your income and expenses going to be from the actual business. But we may have seen certain revenue spikes during and after lockdowns and various governmental shutdowns and things like that we had this year, and that may or may not reoccur. And so you've got to take those things into account. For example, at least in 2020, I'm sure most people had travel way down, and so it's probably well below budget. Again, we don't know exactly what 2021 is going to bring, but my guess would be there's going to be some increase in that. These are all things that we need to account for as we go through these processes.
And to add to that too, one item, to kind of take into, or a couple items to take into account are, did you put other like capital expenditures in place that will help reduce some of your ongoing expenses? Did you switch from, like a type of staffing, or did you add staffing to where you need to take those items into consideration with your current year budget that maybe didn't affect previous years?
Yep, great example, Megan. The next step in that process, comparing those results to prior periods and industry peers, is how to, I guess, first off, a lot of people ask the question, how do I obtain industry data? Well, there's various trade organizations. I think almost everyone has some organization within their industry that can provide information that is with that trade. Online resources like Dun & Bradstreet, WK, we subscribe to several services that give us some information that we can share with clients. And even just comparing that information maybe between locations to make sure that it's consistent across the board, and that what you're maybe have a one location that's doing certain things well and gets different percentages out of their different expense line items, and maybe another one that doesn't, and how can you compare those things and get them in line. But you will have industry organizations that will provide that comparative data. Trade organizations, like we said, those are going to be, I use Williams Keepers as an example. We're part of a group of firms that gives us access to industry averages, and everybody provides their information into that group and is able to spit out some comparisons, and maybe every industry is not like that, but there's going to be something very similar.
And to add to that, I think you get to, the end of a budget process and you think, okay, net income looks great, but using some of, the comparison to your peers will help challenge to see whether or not you are operating as efficiently or as well as you think you are. So, you can start looking, and we'll get into this a little bit with KPIs, but, what is your gross margin? What is your, percentage going to advertising and, overall operating expenses? And when you start lining those up with your peers, that's where you can really start to then hone in on, okay, this is definitely an area we need to look in detail. Let's look further and maybe reevaluate our advertising strategy. Is it the most efficient, with bang for the buck? And that's one of those, it just helps you kind of ask some of those questions. And at the end of the day, if it's working for you and it's producing the results that you want, then it can be worth it. But it at least helps you step back and say, okay, is this the approach that we need, or is there a better way to do it?
Yep. I think we're a couple slides behind.
Oh, sorry. There you go.
Oh, there you go. Okay. Let's see here. Sorry, had a screen issue. So as we evaluate, again, what else needs to come into play as we evaluate these future needs, obviously we may have different departments that have different budgets. We may have strategic initiatives that are going to meet our goals. We may have staffing additions. We may have contraction. We may have additions to our staff that where we used to outsource something where we're bringing them on, or vice versa. We may have capital improvements or expansion that we're trying to budget into this, or to build into the budget. Typically, the budgeting process is going to start at a pretty high level in an organization, whether that's with the owner and high level management and coming down, or just in the accounting department. But I would say, particularly as your organization gets larger or building up through those, you need to consider bringing in department leaders, and maybe looking at those departmental budgets so that you get better buy-in from them, particularly if you're trying to hold them to meeting that particular budget in their department, so that it's not just something you put in front of them and expect them to toe the line. Also, I think considering who else besides those leaders may help to get input from, in order to get full buy-in and cooperation on the process as we go forward. So again, you can't just say, hey, I came up with the budget and this is what it is. You want it to be realistic and make sure it's going to work. And so you need to make sure you're getting thoughts of everyone who's, maybe not everyone, but who provides the feedback that's going to help you get the strongest, most realistic budget in place. So as we said, budgets can be very summarized and at the same time can go very detailed. And I think what we see a lot of times is that there is that next level. There's always, here's my budgeted P&L, and this is what I hope to accomplish from an income perspective during the year. And those might simply be limited to either accrual income or cash income. The difference between those essentially is when income and expenses get recognized. Cash basis is when it came in and when it went out. Accrual is essentially when it's incurred, whether you've earned the income or incurred the expense. And so those two things can provide, if you're looking at that from a different either method of accounting, from an accrual basis to what I'm going to wind up with on a cash basis, can be significantly different. And so if you're doing a budget on accrual basis, you want to make sure that you're factoring in the impact of accounts receivable and accounts payable and where that timing goes in. So even if you're increasing revenue significantly, and maybe you're expanding your customer base, as you expand that customer base, is that going to cause you issues with either timing of accounts receivable, where you may have more accounts receivable out there at any given time, but also maybe collection issues and things like that. How that's going to impact your loan payments, because if you're only budgeting for your P&L, loan payments, debt service is not going to hit that P&L other than the interest. Capital expenditures, if you're investing in equipment or building improvements, things like that, those also are not hitting that P&L. And distributions, money out the door, if you're not counting for how the cash is going to come in, you're just hoping it aligns with the income statement, you may or may not have cash for those distributions. So something that you need to take into account, and maybe take that budget a step further and say, okay, this is how my income statement's going to look, but what are the non-cash, or what are the cash items that are not necessarily on that income statement, and how's that going to impact where my cash is going to go to. Along with that, particularly at certain times, you may find that if you're budgeting where your cash flow is going to be and what your needs are going to be, you may be able to take advantage of certain things. Like maybe you've got an excess of cash right now. Maybe you've got a large project that you're working on, whether that's a capital expansion with a building or equipment that maybe you can pay for now without dipping into debt or your line of credit, knowing that, hey, I am going to need that cash in 6 months, and so I need to have financing in place for 6 months from now, but I can use the cash that I have excess on right now to basically save myself interest. And so those are things as an advantage to budgeting beyond the income statement and making those cash flow projections. Obviously, line of credit needs, tax payments. If you plan for these things before they happen, it's definitely easier to handle. Obviously, line of credit, it's easier to go to the bank and say, I need more money when you don't need money, but you know it's coming, than if you wait until the last minute and you're asking for something on a quick turnaround. So I think once you've kind of reached this point, you definitely and you've put this budget together, you've checked it for reasonableness, you've run it through your internal system of leaders within your organization, and you feel like you've got a good budget, and maybe even as you're going through, you want to make sure that you share this with department leaders, share it with advisors, particularly if you've got a sales team that needs to be hitting certain things. They need to know what their budget is, at least from a top line standpoint. This is going to help to build the expectations and hold people accountable. You may have a bonus plan, or may want to consider having a bonus plan that's at least partially reliant on the performance against budget. And you need to ensure that the team has reason for the budget to succeed and have skin in the game. And that's where a lot of times some kind of budget or a bonus program is very helpful in making that happen. But it's hard to hold people accountable to something when they don't know what the expectations are. And so you want to share this budget with those that it's going to impact. Make sure that their goals align with the goals of the budget. So, for example, sales team, if they think I just need to sell more to make budget because the top line revenue is really a stretch, and they accomplish that by selling a lot of lower margin items, that's not necessarily going to meet the goals of the budget. And so you want to make sure you've got everybody on the same page.
And to add to that, I think it circles back to the initial part of it, which is getting your department leaders, your sales team, involved from the beginning in helping set those goals. So because if everybody from the beginning says, okay, I think 10% revenue growth is attainable, we can do this, and then you share the budget at the end of it and say, okay, we left it at 10% or moved it to 12, there's a lot more buy-in, and it's easier for people to digest and say, okay, we can do this, as opposed to if they've had absolutely no input from the beginning. And sometimes there's a right or wrong way to do this, but it is ultimately, let's get everybody's buy-in, know what we're working for from the beginning so that we can attain those results, as opposed to anyone kind of being just surprised on the back end of, oh, great, now we're going to cut 10% expenses. I haven't even looked at how I can do it. This just gives everybody the sense from the beginning of ownership and starting to think about how they're going to accomplish those goals.
Yep. Good. So that's kind of the budget of putting this together. There's quite a bit that goes into it, and a lot of thought that needs to go there. So kind of the timeline that we typically like to see is you're going to develop the budget. You're going to review that monthly or quarterly in a comparison to budget to actual to see how you're doing. And there's going to be times when you may need to reproject some things or forecast results to see, what's happened or changed during the year that allows you to maybe refocus and still hit that budget. Your budget's your budget. So once it's set, anything after that is going to be a forecast that you want to take additional information into account, whether that be market changes, staffing changes, some other industry change that's going to help things. So again, back to that, developing the initial budget from a timing standpoint. I'm sure every organization has a different starting point. This isn't necessarily always just a end of the year, first of the year thing. Some organizations, the budget is always, it's always in process, if you will. It could start as early as summer, but typically it's going to start sometime in the fall and hopefully wrap up by the end of the year or January. Make sure that you're leaving plenty of time to have multiple iterations for that. And I think another thing to consider as you're building that budget is to make sure that you build in. I don't recommend that you just do an annual budget and that's the end of it. I think you have to build in not only what your annual budget is, but also what that's going to look like as you move through the year. So every business, maybe not every business, but most businesses are going to have some sense of seasonality. It's not going to just be, here's my annual revenue divided by 12 and here you go. There's going to be certain months where you're going to be heavier than others, and you want to make sure that you've accounted for that at least in some way. And the same on the expense side, because as you move to the next step in this budget process of comparing that and seeing how you're doing during the year, if you haven't done that, you're going to have problems because you're going to have months where, hey, I had 3 payrolls this month. I didn't take that into consideration when I built the budget. And so now I have extra payroll costs. Maybe that balances out throughout the year. But it doesn't give you a sense of really where you are from where you plan to be. The same as, again, I'll use Williams Keepers as an example. If we took our annual revenue for the year, divided that by 12, we have as everyone's probably aware, a very intense tax season at the first part of the year, in most years anyway. And that's going to, if we just took our revenue and divided by 12, we're going to be way up at the beginning of the year and just bring that down as we go through. And so if we don't impact our budget for that seasonality, we're really not going to know where we are until the end of the year. And the whole point in this process is to make sure that we can see where we are as an organization as we move through the year and comparing that to where we expect it to be, or hope to be. So again, we're going to review that monthly, quarterly comparison of budget to actual. The way we typically look at that from a comparison standpoint, you kind of start at the bottom and you work back through the details, or you start at a summary level and maybe work back through the details. So you look at that net income and say, hey, are we on target? If we are, great. You're still going to want to look at the details just to get a little more analysis, but I think your red flags aren't necessarily up. So if you're on target, that's great. If you're not, you're going to move in and see, why am I not on target? Typically, you're going to start with revenue. You're going to say, are we meeting or exceeding our expectations? If not, what factors are contributing to that? Can we change something to still be able to meet our targets? Or was our budget even accurate to start with? And we may need to pivot to look at that. If for some reason we believe that our revenue is not realistic, either because something changed or not, we maybe need to make that up on the expense side. We look at those expenses, same thing. Are we meeting or exceeding expectations? If not, what factors are contributing and what could be changed to meet those targets? There may be some things where, hey, we're over on this budget line item, but we're under on this one. I think you're looking at those from which ones are significant. So a common area there that might happen would be maybe payrolls up and contract labor is down, or vice versa, because we either outsourced something or we brought that outsource in-house. Though that's an example of, it didn't really change the budget overall, but it was something we pivoted during the year and decided to do, and the impact was not necessarily a net change, but it changes the line items, and so we have to be considering that when we're comparing it. And I think, you've also got to look into, why either income and expenses are down. Are there issues particularly when you have different departments or different locations? Maybe one department's doing fine and another one's not. Why are those differences out there? Are there issues at a certain location that need to be addressed, or maybe things that are out of your control that you can't handle? But you need to review this budget to actual on a regular basis to be able to accommodate any adjustments that need to happen. So again, as you're reviewing that, there's going to be times where there's variations. And again, as you ask yourself the questions as to why, you're going to probably look at how do I pivot and change things? And so what is it that I need to change, and how is that going to impact those variations? And so you may look at, you have your initial budget, but you may want to change and reproject and forecast those results once you decide, hey, I'm going to make this change, and see how that's going to impact my budget on a go-forward basis. So using Excel and other programs that work with your accounting software may help you look at essentially setting a new budget without discarding the old, and see where you can come in with those plans.
I mean, to add to that, John, I mean, this year was a perfect example of kind of using your budget as your baseline. But, you know, when COVID came into play, a lot of businesses, it was, okay, all of a sudden, either our revenue went through the roof or our revenue, you know, tanked or whatever it may be. And so then what expenses are adjusted because of that? So maybe your travel went down, but all of your, you know, your office expenses went up whenever you were continuously having to sanitize when you know, weren't planning for that. So a reforecast, or a forecast in this case, is going to help you then say, okay, here's actually what's happening now, 3 months into the year, 6 months into the year, what changes have already been made and we know are coming as well, so that we can say, here's kind of our new standpoint of at the end of the year where we're going to end.
Great. Yeah, well, I think that's what we've got on budgets. Megan, I think you're going to take over and talk about KPIs and.
Yep.
Okay.
All right, so key performance indicators. So these are kind of a next step then when you've got a budget set, or maybe you don't even have a budget set, but you're starting to want to measure how your company is doing. So your key performance indicators, or KPIs, as you're going to see, will help you monitor that performance. They'll also help you kind of focus on the strategic, financial, operational metrics, and they can help you compare your business to your peers in the industry. So for instance, you might not be able to look at a peer's financials and say, I'm at 5 million and they're at 5 million, and here's what my bottom line is. But you can at least get some industry data to say, hey, I'm at 5 million of revenue and margins for my industry are 30%, but I'm seeing mine are at 15%. Okay, what's the difference? Where do I have some overages? So again, you think you're doing okay, but is this actually a reality compared to others? Are the margins high enough that helps you effectively look at, is there room to maybe raise pricing, reduce expenses along those lines? So they can mean more to different industries. So for instance, a construction company might have different industry metrics than a grocery store. So you have to decide, you have to start evaluating what are the KPIs, the key performance indicators that are important to you based on your industry standards, your operational metrics, also loan covenants. So for instance, if you have a certain debt coverage ratio that your bank is requiring due to your financing, you need to keep an eye on those to make sure that what you're doing operationally won't put you into an issue where you're not meeting those covenants. And then from there, and we'll get to talk about these in a little bit, but you know, trending dashboards, those can be helpful tools in tracking and evaluating some of the KPIs that you're seeing. So you can start to visually see where, for instance, your margins are declining, so you can proactively jump on top of it. For instance, if we'll talk about some specifics again in a minute, but if you start seeing, okay, my revenue on this graph is declining 2% here, 2% here, 2% here, you're not going to see as much of a variance if you're just looking at, okay, month to month, you know, here's how much I declined 2%. But if you start seeing it trending, you can see, okay, I'm continuously declining. I'm not seeing an upswing in my revenue, for instance, or based on previous year where we were at this point, I'm not seeing an uptick. So the dashboards can really help us visually put that into place. The other thing too, there are different, you know, softwares when we're talking about all of what we're doing, different softwares for different industries. And so there are some out there in the industry that could work with your programs. Excel, of course, is going to be the easiest one to start doing some of this tracking. But there are programs like SciSense, Fathom, Scoreboard, Dimensional Insight too, that sometimes can sit on top of your accounting program. And can go ahead and generate those dashboards for you. Okay, so let's talk real quick about some of the key performance indicators that are out there. Again, these are going to be ones that you need to determine if they're important to your industry and to you to monitor operations. So some examples are gross profit margin, net profit margin, debt coverage ratio, current ratio, net sales to inventory, EBITDA, which is earnings before interest, taxes, depreciation, and amortization, revenue growth. So that's a good trending item that you can look at. You can look at revenue growth by income source. So if you have different product lines and you're trying to evaluate, okay, this product line seems to be increasing, this product line is decreasing, do we start shifting some of our efforts more towards one, or contrary to that, has something been dropped? Our sales team has stopped pushing one income source versus another. So that really, like when you're looking at depicting it on a dashboard, that can be really helpful. So looking also, EBITDA to sales is an important one in valuation. We don't have that on the slide. AP to sales, capital expenditures to sales, those all have different kind of meetings behind them. We'll go over a few of these today, but again, if there are any questions that you've got on what some of these mean or what might be important to your industry, definitely reach out to us and we can kind of help you through that. Okay, so the first one on here is gross profit margin. At the end of the day, this is going to tell you the amount of money left over from your product sales after your cost of goods sold. So you've got $1 of sales. If you have 70 cents of every dollar is going towards your cost of goods sold, then you're going to know that you have a 30% gross profit margin. Or in this case, we've got an example that shows 100,000 of revenue. If we have 40,000 of cost of goods sold and divide that by your 100,000 of revenue, you're looking at a 60% margin. And then at the end of the day, what that can tell you is, okay, I've got 60 cents essentially out of every dollar to help cover now all of my, selling expenses, my interest, my administrative expenses that are out there that are outside of my cost of goods sold. So of course, when you're looking at your gross profit margin, the higher your gross margin is, the better. But these again can vary by industry. So if you look at, a manufacturing industry, it's going to be different than a service industry. You're going to be, much higher maybe in a service industry than in a, manufacturing, or vice versa, depending on what it is that you're producing. So the next one here is net profit margin. So net profit margin is going to express how much of each dollar of sales will result in bottom line net income. So this is, at the end of the day, net income divided by revenue. So for easy math here, we've got the example of a company that makes $10,000 of net income. If originally they had $100,000 of sales, what that's telling me is 10% of every dollar I bring in is going to result in net income. So, when you're looking at where can I push, you're wanting, I guess, at the end of the day, look at this based or compared to your peers to start to evaluate, am I doing great? Can this be pushed to a higher percentage? One thing too to look at, not necessarily just at net income, but is EBITDA, which we just touched base on. So EBITDA is earnings before interest, taxes, depreciation, and amortization. And you can divide that by your total revenue. What that does is it really helps in specifically like valuations or taking out kind of what capital investments or debt you've put into the company, and really just helps baseline evaluate what's the operational picture. How much are they making without any type of loan servicing, for instance? And so it's more of an apples to apples comparison and a better determination for valuations. All right, so the next one we talked about was debt coverage ratio. So this, of course, I'm sure almost everybody on this call is familiar with in regard to lending, but it helps essentially tell your banker the ability to generate enough income from operations to cover debt. So you always want this to be a 1.2 or higher, and the different loan covenants can modify that percentage. The 1.2 is more just kind of an industry standard. But what you're going to look at there is, your net operating income divided by debt service. So for instance, we've got an example here of 20,000 of net income divided by, if you have 15,000 of debt. So this is going to be your principal and interest together. So if I only made 20,000, 15 of that is going out the door for just debt. I have a 1.33 debt coverage ratio. If you think about this in terms too of maybe my debt was actually 20,000 instead of 15. So I would have 20,000 of net income divided by 20,000 of debt. That's a 1.0. And essentially what that tells your banker is literally every dollar you make goes out to loan payments. So as you can see, a 1.0 is not desirable because you're not able to really, you can pay your debt at a minimum, but there's really no excess for anything else. And that gets into a much riskier situation. The next one on here is the current ratio. So it's just a measure of the company's liquidity or ability to pay short-term debts. When you're looking at these, again, it's important to know what you're talking about. So current assets are those assets that can be turned into cash within a year. Same thing, current liabilities being what needs to be paid within a year. So you're going to consider accounts payable, some of your accrued payroll, taxes payable, loan payments that have to be made within a year. And so what this ratio is doing, and essentially it's just current assets divided by current liabilities. And it's just indicating, so the lower the ratio indicates a higher of a risk of default. So when you're looking at not having enough assets to cover your liability. So for instance, you don't necessarily have a lot of cash, you don't have a lot of liquid assets that can be used to pay, for instance, your accounts payable. That would indicate you're going to have issues with paying those down. Maybe you need to look at other options. Maybe you need to look at retaining some cash within, if you're continuously stripping cash out, you need to start retaining some cash in order to be able to stay current on your liabilities. A high ratio to that regard also indicates that a company might not be using their assets efficiently. So you just have a lot of cash sitting there and it's not doing anything. Is that the highest and best use of it? Do you need to start looking at, capital improvements? Do you need to look at other investments that could help increase your return? The next one on here then is net sales to inventory. So for anybody with inventory, it is a pretty good indicator of a rise in inventory. It helps track your merchandising efficiency. So if you have a high ratio in this case, you've got management moving inventory sufficiently, a low can signal inventory problems. It can also help you evaluate at the end of the day, depending on how this comes out, as far as, is there a deterioration of inventory? You could have seasonal fluctuation in inventory levels. So maybe it's too high for a certain period of time, but again, that can all be dependent on the industry that you're in. There could ultimately be an overvaluation of your inventory. So that is where you might need to look at, is there a potential write-down we need on our inventory that we're holding here, because part of it just needs to be written off as unsellable, or it can indicate to a change in customer preference. So as far as the calculation there, you're just doing, that one's pretty easy. It's net sales divided by your inventory. So as you can see here, we've got an example of, you've got $1 million of sales, and divide that, if at the end of the period, so in a month, you've got $600,000 of inventory. You're at a 1.66. If you have the same amount of sales, but you're holding 500,000 of inventory, so you've reduced the amount that you're holding by 500,000, you're at a 2.0. And this number would go up the less inventory that you're holding. But what you can see then is $100,000 of cash essentially has been made available by not holding as much inventory, or possibly you don't have $100,000 extra in that second situation on a line of credit. So which can then reduce some of your interest expense. So that's where these ratios, especially as you start tracking these over time, you're going to be able to see, okay, here's kind of the inventory level that we need, or hey, we've seen a spike in this. We need to start diving into what's going on with this, and it really just gives you an operational notification that there might be a bigger issue out there. Another one too, the collection period indicates the amount of time it takes to receive payments for sales on credit. Any companies which, a lot are reliant on receivables for cash flow. And so the longer that money is sitting out there, the more of an issue it is, you're not getting cash in the door. So we've got an example here, I'll walk you through and kind of talk about what that means. So we've got the collection period equals your accounts receivable. So end of November, I had in this case $750,000 of accounts receivable, and I'm going to divide that by my sales per day. So I looked at just for that period, I have $1 million of sales. What that's going to tell me then is I'm collecting those funds every 22.5 days. However, if my accounts receivable is higher than 750, that number is going to go up. And the next example where it's 1.5 million of accounts receivable for the same amount of sales, same amount of days, it's 45 days. So you're looking at it taking you twice as long in that second example to collect the funds. Again, this is good to track over time. What is reasonable? Are we starting to see an uptick? Because you can start looking at what are changes that we can make to reduce the amount of time it's taking to collect. So for instance, do we want to offer a discount, like a 210, so 2% discount if paid within 10 days, or if you pay within 30, no discount. So that incentivizes good behavior. You could do cash on delivery for problem customers. So that'll help reduce the accounts receivable and the number of days it takes to get your money. Starting a collection process on some of your old ones, on your old accounts receivable to, again, this is all incentivizing people to pay as quickly as possible. And then in turn for your business, it is going to lessen, the amount of risk you've got out there. You're going to possibly reduce interest payments if you've got money on a line of credit. Because if you're not receiving that money, you're having to maybe draw on that line of credit, which then results in additional interest. All of these are issues to kind of look at or keep an eye on some of these metrics in order to maybe model some of your operational behavior around that. So then let's just talk about what do you start doing. When I started talking about trending, it can be as simple as looking at what are the metrics, for instance, on the collection period. So I can look at what is it at the end of January? What is it at the end of February? What is it at the end of March? And what you'll start seeing is you're going to note not only kind of where your average is, you can also start looking at where am I trending? So if my collection period is trending up, was there either then a situation within the industry that caused this? Was there, maybe people received PPP money and started paying down accounts payable or any of that. And so you're going to start seeing changes in the industry or within specifically some of your policies that will help drive some of these KPIs over time. So trending is just literally looking at where am I at either in 2018, 2019, 2020, or by month over a period of time. And then the next step with that is a dashboard. So what graphically presenting what the trending. So I can see, okay, my line for revenue, for instance, my net sales. I can start seeing, okay, that's going down 2%. Here I see a slight decline. Let's start looking into it. And then when you especially see a large decline over a period of 3 months, 6 months, whatever it may be, it's going to be a better indicator to you, hey, we really need to look at, is there a problem? Or is this expected? Maybe there is some seasonality. And so here's one where we would recommend too, that if you can get historical data in here, that helps tell a better picture too of what will happen. So for instance, if you're in snow removal or tax season, for instance, you're going to see larger swings at one point of the year versus another. And so you can at least see, okay, based on where we were in 18, where we were in 19, 20, for instance, is this anticipated or is there an issue that we need to address? Again, there are different programs that can help you track this. So you can have programs that either sit on top of your accounting program, kind of work in conjunction with it. The absolute easiest though is to work in Excel. You can create a simple chart when you just start tracking, okay, by month, this is where we're at, by year, and start seeing those graphically. So here we've got an example again of what is the picture telling us, you know, and if I start looking at it, I can note in this particular example, I know in August, we lost a large client at this company, one of the largest clients. And so net sales, I can start seeing in August drop down significantly. And then we're really starting to see the impact of that over the next few months. Now, if you're dropping associated costs with it, that's great, but you also need to keep an eye on total net income. What are the implications of that? This just really helps you keep graphically your eyes on what's going on. So to wrap up kind of with the KPIs, the biggest takeaways are really, there is no one size fits all. So what, for instance, Williams Keepers uses is not going to be what a construction company uses, or somebody who is in, you know, a merchandising company. It's definitely based on what your industry needs are, your lender requirements, what works for you as operations. So what does your team need to see in order to drive areas that you want to see driven? And helping, just make sure you're tracking this, whether it be monthly, quarterly, by year, because if you can proactively see these indicator, like your KPIs going one way or another, you can immediately start to make operational changes to say, okay, because this is not working, we're going to shift and go this route. Or, hey, we saw a decline in sales. Do we need to see a decline in, you know, cost of goods sold, payroll, maybe closing a location? It just helps you ask those questions and be more proactive as opposed to at the end of the year thinking, whoops, we just didn't make our numbers.
Megan, okay. I think just throwing in on those KPIs on the overview, I think that the KPIs can really go hand in hand in analyzing your budgets, particularly your budget to actual, and maybe helps to identify some pivot points or helps to identify changes you might want to make to your budget as you go forward. But I think even the way that those key performance indicators are going to help you analyze things would be, maybe you see an issue on your budget to actual and how your budget is, or how your actual is performing versus your budget. You may want to look at that and say, what is a key performance indicator that can help me see how that is trending, and being able to track that from a historical standpoint, and try to see then, not only on a historical standpoint, but as we go forward, how is it making those changes and helping with that. The dashboards that summarize the KPIs for a company, that this is definitely probably the nerdy accountant in me, but that's really cool to see all that information visually, and be able to see how are the trends going and where that's moving with our numbers.
All right, so I think we, welcome any questions that you guys have on the topic. We just did a couple of questions, which is, what are some strategies for the manufacturing company from a finance standpoint? I think one of the first ones that I would say is the collection period. So what, how long is it taking for you to receive the money from customers? I think that's a huge one in order and credit and staying as quickly as possible. And then also say sales and inventory is a big one, just for the fact of
helping track, are you consistently moving your inventory, or are you, okay, issues moving that inventory, maybe you have an overproduction, and can you hear me?
Again, it sounds like your mic went a little nutty.
Can you hear me any better?
Okay, so let me try to take that question. So the question was, what are some KPIs that we could recommend for a manufacturing company from a finance standpoint? I think particularly some of those that we would hit. Let me find that list so that I can get them on there. But net sales to inventory is something that's going to kind of help to compare that inventory level to the sales and see if you've got kind of that appropriate level there. The collection period, trying to, again, what you're trying to do is look at how your inventory is set and how long it's taking you to get the money to replenish that inventory. Obviously, gross profit and the standard sales and things like that are going to be important. But I would say one of the main things in a manufacturing standpoint is going to be looking at your inventory and also your AR and how those are going to function together. Any other questions that we can maybe answer? Let me see, we got a follow-up. A recommended benchmark for a collection period, KPI, and net sales to inventory. I think what I would do is really kind of go back into some of the formulas that Megan's lined out in the presentation and try tracking those and looking at the trend of how those work over time and seeing, are they steady? Do you have an increase where as your inventory is increasing versus your sales and how that ratio goes? You would want to correct that. But I think the indicators that Megan has put in, particularly related to net sales to inventory, is one of those, and also the collection period calculation. I would look at both of those things and try tracking those and the trends and seeing those on a over time basis. Great. Any other questions? Or if not, certainly feel free to send in an email or anything, and we'd be happy to try to get back with you. And we really appreciate you guys taking the time to listen to us this morning. And Megan will try to return to her normal state and be away from the robot that she turned into in the last 5 minutes. So I believe Jen is going to post all of this information this afternoon on our website. And so, again, we appreciate the time that you guys took to listen to us, and look forward to talking with you soon. Thanks.